Hello and welcome to View from the Top. I am Modeli Sharafa Yusuf. Last week, the CBN's Monetary Policy Committee met for the second time under the chairmanship of Mr. Godwin Emefiele. The meeting was against the backdrop of rising inflation rates and declining crude oil price at the international market. What are the implications of the committee's decisions for the economy? The banking industry is the fulcrum around which the rest of the economy revolves. How can the industry expand access to consumer credit, which is becoming increasingly important to the national economy? Today, I'm being joined by Dr. Alex Otti, the Group Managing Director of Diamond Bank. We will be discussing all of this and politics. Dr. Otti, thanks again for joining me. Inflation crept to 8.5% in August from 8.2% as of July, and economists say this is largely attributed to rising food prices. There have been concerns about this, especially in the context of likely increase in security spending and increased fiscal spending in the run-up to the general elections. How can we ensure continued positive real returns in Naira-denominated assets in the face of rising inflation? And what can be done to keep the inflation rate down?
Thank you very much. Yes, you're right. Inflation is one of the major issues that regulatory authorities, particularly central bank, have to battle with. And in the face of insecurity in the country, particularly in parts of the Northeast, it is expected that things like this will happen. You notice that a lot of the states are under serious pressure. So when you talk about farming, the level of farming has gone down. People have left their homes and they are either on the run or they are in camps. So it's expected that it was going to happen. Now, for central bank, I think they've also predicted some of these things, and what they did was to ensure that there is some control in terms of money supply. Because what basically happens is that if a lot of money is chasing fewer goods, that is what inflation means. So the tight monetary policy is expected to tame rising inflation. If you noticed in the last couple of days, the Monetary Policy Committee met and left monetary policy rate at 12%, cash reserve ratio for private sector funds at 15%, and cash reserve ratio for public sector funds at 75%. All these are aimed at restraining the ability and capability of banks to create money by lending and make lending a little bit more difficult. So with those kind of restrictive policies, we expect that we will not have runaway inflation that will go into double digits. Secondly, you also know that we are almost going into an election year. So there will definitely be increased spending by politicians and by political parties. So central bank, I believe, will also come up with some more strategies to tighten money supply. So we expect that all these measures that are being put in place by central bank, in cooperation with the banks in Nigeria, would at least restrict the quantum of money supplied in the system, and will also tame rising inflation. My guess is that we may get into the lower double digits as we get into 2015. But shortly after the election, I believe that things will begin to correct themselves.
There was a second quarter GDP growth of 6.54% as against the 5.4% growth rate in the corresponding quarter of 2013. What are we doing right? Which economic policies have helped to foster this growth?
This is a very large economy, 170 million people, and even counting. So once you factor that into the very rich resource base of the economy, you will see that we can actually do much more than the 6.54% that you talked about.
So what's keeping it at that rate at this level?
What's keeping it at that rate is, first, there have been some stability in oil prices. And then there have also been some stability in the export, in the quantum of oil that we are exporting. Then we have some measure of growth in the agricultural segment of the economy, and we see some improvement in infrastructure, particularly power with the power reforms. We also have seen some movement in other resources. When you talk about, Nigeria is so blessed with resources other than oil. Gas is even untapped. So the potentials for this economy are quite high and can actually do much more than where we are. If we fix infrastructure, and I think we are doing very well with power now. If we fix the roads, and we can get a whole lot more people back to work. We can get the entrepreneurs do their thing, and I believe that we can actually do more than 6% in terms of GDP growth. There are a few countries in Asia that have attained double digits in the past couple of years. If we have more people going back to work, if we have stability in all the parts of the country or major parts of the country. Today we talk about Boko Haram in the northeast and elsewhere in Nigeria, and these are actually impediments to the level of growth that we should experience. I see GDP growth in the 9 to 10% in the next couple of years.
As you said, agriculture contributed a great deal to this growth, and it's considered the sector that can do the most to help ease the chronic unemployment situation. But why aren't banks supporting agriculture more?
It's a very good question. Agriculture is the way it's practiced in Nigeria. A lot of our farmers are still involved in what we call subsistence farming. And that basically talks about producing for your family and maybe a little to sell in the market. So we are working towards making agriculture a business. Now, until you achieve that, you are not going to get the level of financing that you get in other areas that have been organized in that form. I'll give you an instance. Today, in my part of the country, we see corn and pear, and that is what is in season. So what basically happens is that a lot of people produce, eat, and take to the market. Prices are depressed, and whatever you don't sell in a day, you either destroy or you give out. If you're able to put in place storage facilities and processing plants, then you find that you have corn all around the year, and it has been done elsewhere. Now, that is the job that will be undertaken not by the subsistence farmers because they cannot afford it, but both by government and cooperative societies if they organize themselves in that form.
You talked about rates a while ago. I know that bankers like to say that if interest rate rises, the banks are not the cause. They only react to policies of government. But how can we keep borrowing costs down to ensure you don't crowd out the private sector?
Well, first of all, you don't give what you don't have. So the first question to ask is, do you have a bank account? I'm sure it's yes. Do you have deposit with banks? Maybe yes. If you have 10 million naira today and you want to give it to a bank, at what rate would you want it given? I'm sure you'll be looking at double digits. So that's the issue. So if you are raising deposits in the double digits, it's difficult for you to lend them out in the single digits. So that's the reality.
So what can we do to bring down
exactly
both deposit and
yes,
rates?
I'm coming to that. It depends on what is important to you. I started by talking about the monetary policy rate and the issue of inflation, and of course I didn't talk about exchange rates. Those two are uppermost in the minds of a central bank governor. So if you want to keep down exchange rates and you want to also hold down inflation, then you have to do things that will not be very attractive to the borrower. If monetary policy rate is 12%, 12% is the risk-free rate. That's if you do nothing, you should get 12%. Now, if a bank lends, every naira you lend, you have to take a general provisioning of 1%. So that takes it to 13%. Now you have to also provide for deposit insurance premium, NDIC. That is 15 over 16 of 1%. So you call it 1%. So that takes it to 14%. Now there is also some cost, called resolution cost that all banks bear. So at the end of the day, you will find that the kind of rate you'll be talking about will not be 12, maybe it's 15, it's 16, it's 17. The first thing that you will do if it becomes very important for you to tame interest rate, and that should be at the expense of exchange rate and inflation, is to bring down monetary policy rates. And I'm sure you remember when monetary policy rate in this country was at 3%, sometimes it was at 4%. Interest rate on deposits were sometimes about 2-3%. Interest rate for lending was hovering about 6, 7, 8%. But that was possible at that time because of the conditions that we were in. Now, today, we are fixated about the exchange rate of the naira to the dollar.
You have been quoted as saying that the current situation whereby we spend about 80% of our national revenue on recurrent expenditure, leaving very little for capital investment, is unsustainable. And that this is why we continue to face problems of youth restiveness, among others. Can you explain further?
What I was talking about is that if we have a large chunk, a very, very large chunk of our national budget into recurrent expenditures, and there we are talking about salaries, we are talking about things that you consume within 1 year, that it portends danger for the economy. And there are not too many economies that operate that way. So the point is that we need to begin to look at how to reduce that number and be heading towards the 50-50 mark. Because if you do not allocate funds to capital expenditure, things like roads, power, all sorts of infrastructure, including water, you will not be able to take care of them. And if you do not invest in capital, what you find at the end of the day is that you have infrastructural decay, companies begin to fold up, and then you are unable to generate employment for your team use. Today, National Bureau of Statistics has it that unemployment rate in Nigeria is about 25.6%. That's awfully high. In countries like the UK, where unemployment is about 3%, people are actually screaming that unemployment is too high. In the US, it's about 3.5%. So the point is, yes, we're able to carry on because people get some kind of social security that is not legislated. You come into a place like this, you have brothers, you have sisters that you are taking care of and all that. But if we did not, if a few of us who are employed are not unable to take care of some of our wards and our dependents, it will be a disaster for the country. So it is important that we begin to take deliberate steps that would have us reduce the level of recurrent expenditure in favor of capital expenditure. How do you do that? Is a discussion for another day. But then you have to reduce the number of people you have in the services. Well, we can, and that's why I started. And I said the first thing that you need to do is to reduce your salary bill, your wage bill, and different ways of doing